Welcome to the 88th episode of the Work-Life Balance podcast. As you can already tell, first we have a guest, and second, today we're doing this in standard German. There are several reasons for this. There are several reasons for this. On the one hand, we want to expand our reach a bit, or at least try to, so that we can also reach our colleagues in Germany and Austria. On the other hand, we want to try translating the podcast into English using Gen AI. And I think it helps if we do this in standard German. And as you've noticed, Marc Weibel is filling in for Sandro today. Marc teaches at ZHW. He is a lecturer for statistics and quantitative methods in the field of data science. And he is very, very involved with programming, portfolio, and risk management. Before that, he was CIO, Chief Investment Officer and partner at the NISO, also head of investment solutions. So he was very involved with rule-based investment strategies there. And in addition, he is the founder and owner of his own consulting firm. Welcome, Marc.
Thank you very much for the invitation. You forgot a third reason regarding the language. My Swiss German is so-so. The accent is already bad enough for Jenny.
We'll see.
The artificial intelligence will, of course, recognize that we are Swiss trying to speak standard German. But we've already tested it once in dialect, and it actually worked quite well. Yes, well, I saw all the places where you've worked. We're meeting for the first time today, and I was really impressed. So much of your work involves numbers, quantitative methods, risk management. So it seems obvious to me to ask, Oki, where your passion for working with numbers comes from.
That's a very good question. Actually, I don't come from a mathematics or physics background. I studied economics and took my first finance course at the University of Neuchâtel. But I have to say, I really struggled with it. But that actually sparked my passion because I didn't know anything about finance at all, although I was already familiar with numbers from studying economics in high school, mainly accounting. That curiosity about finance and mathematics led me to further my education in quantitative finance in Geneva, and later on during my career at the University of Zurich, I earned my doctorate there in mathematics. So the transition from economics to mathematics was relatively difficult. But in return, I got to see such a wide range of things that are, of course, useful for my everyday life.
And that's how you two met?
Yes. Jann was in another team, in a different department, the one where I work now. Back then, I was at the School of Engineering, and we worked together on 2 projects, if I'm not mistaken.
And how did you perceive Jann there?
Very nice colleague.
One of us had to keep track of the time, and the other had to do the work. Now you can imagine who did what.
Okay.
That's a good summary, exactly.
But I hope Jann recorded the time correctly.
I have no complaints. Everything was correct?
Exactly. Today, we want to take a closer look at the topic of risk management, to examine it a bit more closely. Also because for people who are interested in investing or opening a portfolio, maybe buying their first ETF, risk management probably seems like something far off for them. Most of us would rather spend our time booking vacations and choosing hotels then figuring out the right risk management for our financial investments, or finding out what suits us best. I'm a bit curious. When people hear about risk management, most of them immediately think of Excel spreadsheets and quantitative methods. Earlier, I mentioned statistical programs. There are entire teams dedicated to this. We'd like to shed some light on how you might approach this on a more basic level. How can a private individual implement this in their own personal portfolio? Is that even possible? Is it necessary to go that far, to be that detailed, and to immerse yourself so deeply in the topic? And first of all, I'm interested to know, and Jann, is it even necessary, and do I even need risk management if I already have a diversified portfolio?
Yes, you mentioned the topic of vacations. I'm more of the unlucky type when it comes to vacations. That means I always have a plan B for vacations in case something goes wrong. I think the same should apply to risk management when it comes to investing. It doesn't have to be it's very complicated, but I also think that we have a certain subjective idea of how risk averse or risk tolerant we are as individuals because we know ourselves. But most of the time when it comes to money, you quickly learn with your first investment or your first setback that your risk tolerance isn't quite what you thought it was. I've experienced that myself. And in the beginning, you always think there's this discrepancy between when I make a little profit, I think, oh, very good. I take the profit and sell my position. And when things go wrong, you think, okay, it'll work out. It'll work out. And you wait. And at some point, maybe your portfolio isn't worthless, but it's heading towards zero. I've experienced that several times. I think it's important to have these small mechanisms. If someone is good with Excel, of course they can make it a bit more detailed. But for the average investor, you simply have to define certain limits right from the start. When do we pull the plug, or when should we reduce a position? And you really should think about that before you invest, because when panic hits, when Trump says or does something, volatility increases, you usually end up making the wrong decision at that moment. But if you've thought it through beforehand, it also helps you have a certain system when investing.
That also means these events will keep happening, these drawdowns will keep coming in. And as a private investor, you sometimes have the illusion that you can get into the game, and when a correction happens, you'll still be able to react in time and manage your positions accordingly, which of course is usually no longer possible. We saw it in April when these market disruptions happen. They happen very suddenly, and things move very quickly. From a psychological perspective, do you think that's an argument for positioning yourself in such a way that you already expect these kinds of movements to some extent? They'll come anyway. I just have to be able to endure them when they come, so I can't really react. I just have to prepare myself with my allocation.
It's a difficult topic anyway. I've often experienced this with private investors. We did an assessment and the person was ready. Yes, okay, I can tolerate a maximum loss of 15%. That's not a problem. And given the person's wealth, that was justified. But then comes the first crisis, the downturn, and suddenly it's a 5% loss. The person already gets nervous. Yeah, and you really have to stay calm. At 10%, they get very, very nervous. And just over 10%, they pulled the plug. And of course, that was the wrong decision, because later the markets went back up. And yes, I think with these crises, you know they're going to happen. But to what extent or how long they'll last, that's very, very difficult to predict. But if we know, okay, I can handle a 10% loss, I can sleep at night with that, then that's good. You have to stick to that. It's not easy. But if it goes over 10%, you should close the position or at least reduce it. But that's easier said than done, unfortunately. I've experienced that too often.
Is that actually a rule of thumb, this 10%? No. Doesn't that also just prevent you from losing too much capital so that you can recover from it? That's always an issue, isn't it? If I've destroyed 50 or 60% of my investment, then I can basically, it's just very hard to recover from that, right? That you just say, yeah. Or is it very individual how you define that?
Yes, that was just an example. It's very individual. And of course, it also depends. Are you living off your portfolio or partially? Or is it just saved up capital that you don't need until you retire? Or I need the capital in 5 years. That also has an impact on the strategy afterwards, not just on risk management, but also on the strategy. So that would have to be there. That's where the quant comes into play. I can't help it. You really have to differentiate from person to person, depending on the situation, and simply not say across the board, yes, the 10% should apply to everyone. As I said, it's also very, very individual how you react. For example, I know I had a client who, after being down just 2 or 3% over the week, he couldn't do anything, couldn't sleep anymore.
How is it for you, Markus? So in our portfolio, the VLP portfolio, there haven't been any major drawdowns so far, but you also have a track record. In the past, you've also experienced one setback or another.
Well, I'll put it this way. You'll probably say now, how can that be? No, purely psychologically, if you've been invested for such a long time and are fortunate enough to have already accumulated unrealized gains. So as long as you're experiencing volatility in your gains, it feels completely different than if you're experiencing volatility in your losses. Of course, it's a bit annoying when you have to give up some profits from a position where you had significant gains, but it's like, okay, it's easier to handle than if you're in a negative position. I know that doesn't make much sense rationally, but psychologically, I think that's just an aspect. And sometimes with these positions that have very large fluctuations like Apple or Nvidia, if they fluctuate positively in the portfolio, then it's really not that big of a deal for me personally. I can handle that. That's one aspect for me, more the technical side. And the other is, as long as I see that the operating business is making progress and moving in the right direction, and I don't need the money, then fortunately, I can look at these fluctuations quite calmly. I think that definitely helps as well, that you can rely on the investment case continuing to work. How about you, Jann, when it comes to volatility?
We'd probably have to do a whole separate podcast on that. I have some that perform very, very well, and others, well, I already have anecdotes from my apprenticeship days, from my time training at the bank, where I experienced total losses. There are probably some people who haven't even invested yet. You also need to use your brain a little. I think Marc mentioned that well, or put it well earlier. That's money that I can afford to lose. Sure, it hurts. Of course it does, but it's not threatening, and not everyone can handle that. That's certainly a comfortable situation, and it's a situation you have to assess or simply define for yourself, how much can I or do I want to lose, or more importantly, how much can I afford to lose, so that I still have enough left at the end of the month.
The implementation, I actually find the idea interesting that you say, okay, I only want to lose up to this much. But when it comes to implementation, I've just realized for myself that stop losses don't work well for me, because they always get triggered and then the price turns around again. Thank you very much. I mean, how do you actually implement that properly in a portfolio? You have to work with stops, right? Somewhere. If you don't implement it mechanically in the end, then when you're actually in the situation, emotions take over again. And then I might not sell, right? So I somehow have to implement it mechanically as well. How do you approach this challenge?
Okay, so thank you very much for the question. That's a very good question, because I make a distinction here. When we're doing day trading, so when we're really not exactly gambling, but very much trading on a daily basis or over 2 days, 2-day trades, I differentiate that from a real portfolio when we're investing for the long or medium term, because I've also had this experience with day trading where these stop losses are always triggered. But I tried not to set the stop loss too tight, of course, because otherwise those intraday pullbacks keep happening. So instead of holding 2 ETFs or 2 contracts, if you're investing with futures or something like that, you could reduce the position to 1 contract or so, and then set the stop loss a bit wider. Or if the contract size is too large, maybe you shouldn't invest if you want to use this stop loss. So you should find a different product. If you can't set the stop loss a bit more generously, but I don't do it any differently. So I always have this stop loss in place, and I really stick to it consistently. It's not like during the day I think, oh, now the markets are going up. No, I'll just remove it. So it's always done this way. I even try when the markets are rising to adjust my stop loss upwards. Not that I end up saying at the end of the day, oh, too bad, if I had sold at 2 o'clock. I would have made so much profit, and now I'm 2% down. So at least we can lock in part of the profit.
And is this, for example, on a DAX ETF, or what kind of instrument is this, for instance?
Well, from my side, I invest a lot with futures, which means there's leverage involved. These could also be CFDs, which are contracts for difference, where you can bet on both rising and falling prices. And with these, you can use a stop loss, specifically a trailing stop loss, as it's called. And that means if the market rises, but the stop loss, the amount is adjusted upward. I don't know which platform you use, but I've had good experiences with interactive brokers. The trading costs aren't that high, and the platform is also very well designed for private investors. Not in terms of complexity, but in terms of flexibility, which is usually reserved for professional, that is, institutional investors. You can benefit from this. In other words, these stop losses are not just a simple price.
They're not fixed stop losses, right?
You can have them adjust automatically, but if you're more into ETFs, say on the S&P 500, and you also have a bond product in your portfolio, then maybe you don't need to work with a fixed stop loss, but rather review your portfolio regularly. And of course, it could be that you've said 10% is my net tolerance. And at the end of the week, you look at your portfolio and see, okay, we're at minus 11. Then you should still take action here if you don't have that risk tolerance. But it's very difficult to implement this. And for clients to understand that their own psychology or their perception of how they would react is completely different from what actually happens when the situation arises. You notice that the person operates completely differently. And that's why I always say in advance, define clear rules and stick to them. And that's not easy at all.
But sticking to all of it is not so easy.
That's exactly the point. Of course, ultimately, it would make sense to automate as much as possible. And there's also this movement that says, I just buy the MSCI World and do dollar cost averaging. So I just buy a little more every month and let it run completely, automatically. And if the market goes down, I buy. And if it goes up, I buy as well. I only buy this one product. What's your opinion on how sensible such a very simple strategy is for someone who just doesn't want to invest any time and simply wants to let it run?
Actually, that sounds very trivial. At first, at least for a quant one, you think, okay, what kind of, is that even a strategy? But in fact, it's actually a relatively good one if you don't have a lot of financial knowledge or much time to follow the markets and react in a timely manner. I don't think it's so bad to have a mix like that. You mentioned it a bit like a world, but it could be another product where you have a cash reserve so that after a crisis or during a crisis, you can buy more. This simply reduces the average purchase price of this MSCI World product. And there are periods when, this works quite well. It's almost impossible to beat this simple strategy. And of course, there are other periods when better risk management would have achieved a better result. But I think for people who don't have that much time, it's really not a bad strategy.
How do you assess this concentration in the MSCI World now? So from a quant perspective, is that simply the reality of the world that you're reflecting? Because it's not really MSCI World. At the end of the day, it's MSCI America.
The problem is that has changed drastically over the years. 20 years ago, I would say the world structure was still relatively well represented with a clear focus on America, but also a representation of Europe and so on. But as you rightly said, nowadays it's more like, we look at the product, we think it's diversified, we dig a level deeper and we see, okay, 70% is the USA. And within the USA, we notice that maybe 7 stocks are driving the product, basically making up most of it. And that's why I'm not necessarily saying that was more the idea at the cash and investment product. I wouldn't necessarily recommend relying solely on the MSCI World. That's also how I always did it with private clients. You also don't need to, everything is already flagged anyway. You need a certain trade-off between explainability and in the background, these quant things. But we always worked with scenarios so that people are aware that, sure, the markets may have gone up for 2, 3, or even 20 years, or that interest rates have always been low. It's important to also take into account the possibility, especially for long-term strategies, that markets can correct and that interest rates can suddenly rise. And that also helps in designing the investment strategy. That doesn't mean that I would necessarily say, yes, invest everything in the MSCI World. Not at all.
You also mentioned this cash allocation. So if we just assume for a moment, okay, I don't just have the MSCI World in, but maybe I have 3 ETFs that provide a somewhat more diversified picture. And then I say to myself, okay, I'll invest, let's just say an amount, 500 francs a month in these 3 ETFs. Or do I simply say, I have 500 francs available each month. So how much should I invest now during an upward trend? We can ask ourselves, when are we in an upward trend, and when are we more likely in a downward trend? Because as I understood you, it would actually be good to buy a bit more during a downward trend. Yeah. And then maybe just let things run during an upward trend, but perhaps also replenish your cash position a bit so that you have some firepower again to buy more during a downturn like the one we saw in April, for example. I still find it difficult to establish certain rules for that. So for me personally, just off the top of my head, I wouldn't really know how to implement that.
Yes, that's a very good question. I might not have a real answer to that question. Good point. I can also speak for myself when I invest in something like that. It's not like I necessarily try to follow the trend. That means I have a strategy which I might diversify across different investment products. And even if we're in an upward trend, I don't necessarily always try to increase the product or my position in the product. Sometimes it can also happen that for a while, especially when the markets have been rising for a long time, I put my investment system on hold a bit. So I stop investing and wait more for a pullback, so that, as you said, I have a bit of firepower on the side to buy more. I also find it very interesting, especially in relation to risk management or risk tolerance, that many people find certain stocks or start to find certain stocks too volatile and say you should diversify and so on. And these same people, since the Bitcoin hype, have no problem investing everything in Bitcoin and enduring 50% fluctuations in a single day. That's absolutely no problem. That also shows a bit of the psychology behind it. People are absolutely determined not to miss the train when the crypto world starts rising again. But even in this area, I'm more of the opinion that I don't necessarily want to start a catch-up race. I tend to wait for a setback and then invest again. Luckily, I completely missed out on it. For example, with Bitcoin, when it was at 30,000, it stayed stable for a long time. So I bought in and then waited, and maybe I got out at 70,000. Yeah, I don't remember exactly. I thought, yay, very good. Then it quickly shot up to around 105,000. I missed the train. Okay, but I didn't try to chase after it. And then I waited for the pullback, which luckily happened. And then I bought more. But that's very individual again. I don't know. With crypto, do you also follow every trend like that? Or how do you handle it?
We're still discussing it a bit. Actually, in our asset allocation, we have it included at 5%.
That's the nice thing about crypto investors. They grow up in a completely different way. For them, the fluctuations in the stock market are boring by comparison. The typical stock investor has a different frame of reference for the whole topic. So you have to say, yes, those who are coming up now or moving in, they are sometimes more relaxed about these fluctuations than older people I know who already get nervous over a few percent, especially those coming from the world of interest rates.
With these young people, you might run into the problem that there's quite high willingness to take risks, but perhaps the risk tolerance, that is the ability, might not be as high. That could be the problem.
Yes, that's probably the case, yes. But yes, people have also been led to believe a bit that you can make a lot of money very quickly with these things, and that's definitely tempting. I still find it so fascinating how the collective can get swept up in good times, this whole FOMO thing or jumping on the bandwagon. And then when things aren't going so well anymore, suddenly everything is bad again. What I've personally learned from a risk perspective is to consistently eliminate ideas that aren't working quickly, and also not to cash out every profit right away. So sometimes it's about letting positions that are really performing well run their course, and it actually takes quite a bit to catch those. If we're being honest, when we make investment decisions, sometimes it's best to just let those positions ride. And I keep noticing that people tend to take profits too early and let losses run. And for me, that's really what risk management is about, at least as I define it for myself. Now, what I'd really like to know is if I decide to invest in individual stocks or put together a portfolio of single equities, from your perspective, what would be considered good diversification, a good spread? You can probably do too little, or you can also overdo it. I mean, take someone like Warren Buffett. He invests in a pretty concentrated way. Overall, odds probably too concentrated for most people. So what would be a good number? Is there a figure for that? 30 titles? Okay.
Of course, that depends on which stocks you invest in, because we also have this situation. I've seen it with many private clients, and I actually don't think it's a bad thing that people say, I want to invest in stocks that I know or understand. And that's also something I try to do, especially when it comes to day trading. I only invest in financial products that I understand. The exception might be Bitcoin, but I don't do that for day trading. It's more for the long term, because you can. Honestly, you can't. I mean, I can't claim that I fully understand the entire system behind it or the whole process.
That actually makes me feel very relaxed hearing you say that. I'm glad that you're being honest with us about that.
Yes, I have to say it's like this. There was this whole AI world, all the AI algorithms, and on the academic side, of course, we engaged with this topic. Then came this DeFi, that is decentralized finance world, and well, you just don't have the capacity to cover everything in terms of time. And I focused more on AI also with my projects. And I have good colleagues who are very knowledgeable about DeFi. I know the basics, but I can't say that I understand everything in detail. I just try not to do day trading with Bitcoin, because honestly, I might as well flip a coin to decide whether to buy or sell. I don't have a system, and I also haven't been able to create a model for day trading that actually works with Bitcoin. The stop losses always get triggered.
All right, exactly now. You've also told me before that you have a risk management approach, something like an earthquake model, or an analogy to earthquakes, to earthquake models, just like with stock market crashes. Earthquakes are hard to predict, or they're simply not very predictable. We don't want to go into mathematical detail here. That would definitely go beyond the scope of this discussion, but maybe at a later point, we could do another podcast about it, depending on the circumstances. I'm interested to know, did you get a signal at the end of March or the beginning of March with the Trump tariffs? Did anything become apparent there? Could you see it coming? I mean, just with quantitative models, could you have seen it coming, or was it just very erratic? And you would have simply had to follow the Truth Social account to see it coming?
Yes. So this earthquake model, as the name suggests, is based on certain measures of volatility, but not necessarily the kind of volatility that's commonly known in financial jargon. And sometimes, I have to be honest, I see a signal coming from the model, and I look at the chart and think, okay, where is the instability or the predicted volatility? And I'm bad with dates or data, not data in general. Otherwise, I'd be out of place at Jann. No, but I really can't remember the exact date anymore. But the model reacted relatively well in March. That is, it reacted early. Even visually, it wasn't that apparent yet. And because of that, so for the entry, the re-entry point, it entered a bit too early, but overall it was good. And what has also worked very well recently, maybe as a teaser for the next few days. I had a signal in the last few weeks, a sell signal. When the markets, so before the markets actually experienced those drops of 2 or 3% per day, depending, it exited and then re-entered again. When was that? Friday, a week ago. So yeah, it re-entered. A week ago, 2 weeks ago now, it re-entered again. And as of yesterday, there was a signal that things might turn. You don't know whether the signal will be confirmed or not. But it did catch this rebound quite well. But now it's showing certain signs of weakness. That is sometimes very, very exciting. So I have this approach. I always try, when I go to a conference, to attend a topic that has nothing to do with finance at all, maybe to get some ideas. And that might be a topic for further podcasts. I have two models that I use. One has two signals, more medium and long term. And the other is the earthquake model. And the first model is more based on Plankton research. That's the origin of the model. But maybe just to mention briefly the idea behind this Plankton model. I read the paper, saw it, and I have absolutely no experience with Plankton. It usually moves very erratically, just like the markets, actually. That's where the connection to finance comes from. And then sometimes there are certain trends, if you will, where they move together in the same direction. And that was, of course, very, very important for the fishing industry. That's why it was also analyzed using quantitative methods and so on. And when I read the paper, I thought, yes, that's just like investors. So sometimes things move erratically, but then everyone jumps on the same bandwagon, and that creates a trend either upward or downward. And I tried, of course, to calibrate the model to financial markets using different parameters. That also works relatively well. And again, the topic of risk management and diversification. In my allocation, I try not to rely on just one model, but on 3 models in this context, which are very complementary.
Now, for which specific time frame exactly is this model ideal?
The earthquake model can even be used for day trading, so that, maybe not day trading, but it can change from week to week. And sometimes when things are really volatile, even within the week. And the Plankton model is more, the signal is medium term. Let's say, yes, up to a month, 2 weeks to a month. And the other one is more on a quarterly basis, I would say.
So it runs in the background and then practically triggers an email for you.
Exactly.
With a signal?
Exactly. For me personally, it works like this. Shortly before the market closes, it does all the calculations and sends me a signal so that I can act in time. And after the closing, depending on the movement in the last 2 or 3 minutes, there's another signal for the next day in case I missed it. I'm not always necessarily in front of the computer, or when I'm on vacation, I don't check every time. Otherwise, I'll get in trouble with my wife. That's exactly how it is. Everything is programmed. I even had an automated system with interactive brokers for a while, where the signal would actually trigger the trade. But now, there are also certain restrictions for private investors, especially regarding access, or the fact that the platform doesn't always stay online. It always gets closed like that. The problem is solvable, of course, but I just haven't found the time yet to fix it.
Yeah, interesting. We'll link the Plankton paper either in the show notes later for all the nerds who want to implement it themselves.
And Jann, did you notice we need to keep the cash ratio in our portfolio a bit higher right now?
Yeah, we should keep it a bit higher.
At the moment, we have a third of our portfolio in cash. That's quite a lot for me, actually. I don't know, for Jann, it's probably just right. But of course, we'll stick with that for now, right? That's this cautious signal. We don't need to go overboard just yet.
Exactly. Well, I think that brings us to the end of our first episode in standard German. Thank you very much, Marc, and I hope you'll visit us again sometime. Certainly when we do a deep dive, maybe into a more medium-term or long-term model. Maybe we can even program or implement something ourselves. Also for within the framework of the WRT portfolio. Until then, I wish everyone who listened a great weekend and see you next time. Goodbye, everyone.